Picture your whole financial system as the plumbing in a giant building. Money is the water. It flows from people who save it, through banks and lenders, out to people who need it, to buy a home, start a shop, build a factory. When the pipes are clean, water flows, everyone's fine. In 2008, the water suddenly stopped flowing. Faucets went dry across the entire world at the same time. Businesses that were healthy on Monday couldn't make payroll on Friday. And here's the part almost nobody understood at the time. The building didn't run out of water. The water was still there. The pipes had been quietly corroding for years, and one hidden joint, deep in the wall, finally cracked. Everything you've heard blamed greedy bankers or risky home loans. Those mattered, but the real reason the whole thing collapsed is a plumbing problem. And once you see it, you can't unsee it. Now, in real plumbing, there's one pipe that has to be perfect. The supply line that feeds everything else. In finance, that pipe was the home mortgage. For decades, a mortgage was the safest, most boring loan in the world. You buy a house, you pay it back over 30 years, and almost nobody walks away from their home. Banks treated home loans like a pipe that simply never leaks. They were so trusted that the entire global system was built to lean on them. Pension funds in Norway, banks in Germany, retirement savings in Japan, all of it eventually connected back to whether a family in, say, Ohio kept paying their mortgage. That sounds insane when you say it out loud, but that's genuinely how connected it got. The world poured its savings into this one pipe because everyone agreed it was unbreakable. And when something is treated as unbreakable, people stop checking it. That's exactly when the rust starts. Here's where it gets clever and a little scary. Banks realized they didn't have to hold each mortgage and wait 30 years for it to pay off. Instead, they could take thousands of home loans, tie them together into one giant bundle, and sell that bundle to investors as a single product. Think of it like this. Instead of selling one pipe, they welded 1,000 pipes into a giant manifold and sold the whole thing as one super pipe. The pitch was beautiful. One leaky pipe might fail, but 1,000 pipes bundled together? Surely they'd never all fail at once. So this bundle got stamped with the highest possible safety rating, the same rating governments get. Investors loved it because it paid more than a government bond but looked just as safe. Money flooded in from every corner of the planet. And to feed all that hungry money, lenders needed more and more mortgages to stuff into the bundles. A lot more. When you suddenly need way more pipes than the good supplier can make, you start buying cheaper pipe. That's exactly what happened to mortgages. Lenders had already given loans to everyone with solid income and good credit. To keep the bundles full, they began lending to people who couldn't really afford the houses. These became known as subprime loans, just a fancy word for risky loans to borrowers more likely to miss payments. To hide how shaky they were, lenders offered teaser deals. Tiny payments for the first 2 years, then the payment would jump way up. Picture a coffee subscription that costs $1 a month, then quietly becomes $200 a month once you're hooked. People signed because the early payment looked affordable and because everyone believed house prices would only go up so you could always sell or refinance. The pipe looked shiny on the outside. Inside, it was already cracking. And nobody bundling them up wanted to look too closely. Real quick, if you've made it this far, I'm guessing you're finding this as fascinating as I do. This channel breaks down how money and technology really work in a new video every week. If that's useful to you, hit like, subscribe, and tap the bell so you never miss one. It genuinely helps us make more. Okay, back to it. Here's the part that flips the whole story, and it's the thing most people still get wrong. The crash wasn't really caused by poor families failing to pay. That was just the trigger. The real bomb was something called a credit default swap. Stay with me because it's simpler than it sounds. A credit default swap is just an insurance bet on whether a bundle of mortgages will fail. Now here's the wild part. You didn't have to own the bundle to bet on it. It's like letting 1,000 strangers each buy fire insurance on your neighbor's house. If that one house burns down, the insurer doesn't pay one claim, they pay 1,000. So when mortgage bundles started failing, the losses didn't just match the bad loans, they multiplied. A few $100 billion in bad mortgages turned into trillions in side bets gone wrong. The plumbing didn't have one leak. It had 1,000 invisible pipes all hooked to the same crack, and every one of them burst together. At the heart of all those bets sat insurance giants and big banks, and one name became the symbol. AIG, one of the largest insurance companies on Earth. AIG had happily sold insurance on mountains of mortgage bundles, collecting easy money for years. Why not? Those pipes never leaked, remember? But here's the fatal flaw, the plumbing flaw. A normal insurer keeps water in reserve, money set aside, so if a few houses burn, it can pay. AIG had insured so much against something everyone swore could never happen that it didn't keep nearly enough in reserve. When the bundles failed all at once, the claims came flooding in, and AIG simply didn't have the water. An insurer that can't pay isn't insurance. It's a promise made of air. And the moment everyone realized the promises were empty, panic spread faster than any single bad loan ever could. Trust, the real fluid in the pipes, drained out in days. Now comes the moment the whole building froze. When trust vanished, banks stopped lending to each other, even overnight, even for a few hours. That sounds technical, but it's the scariest part of the whole story. Big banks normally lend each other money constantly, like neighbors borrowing a cup of sugar all day long. It keeps the system flowing. But once nobody knew which bank was secretly full of toxic pipes, everyone slammed their wallet shut. Why lend to a neighbor whose house might be on fire? So the lending froze. And when banks can't borrow short-term cash, they can't fund the businesses that depend on them. A healthy car factory, a profitable restaurant chain, a hospital, suddenly couldn't get routine loans they'd relied on for decades. That's why ordinary companies with nothing to do with mortgages started laying people off. The crack in one pipe had seized the entire plumbing system. The water was still there. It just couldn't move. So how do you fix a building where the pipes have seized and nobody trusts the water? You bring in the biggest emergency tank you can find. Governments and central banks did exactly that. They poured staggering amounts of money into the system to get it flowing again and to stop banks from collapsing one after another like dominoes. In the United States alone, one rescue program was authorized for around $700 billion, and the total support committed across various programs ran into the trillions, according to government and central bank records. That's a number so big it stops meaning anything. So picture it as one gigantic water tank wheeled into the basement and hooked straight to the dry pipes. It worked, in the sense that the building didn't fully collapse, but it left two hard feelings that never really went away. Ordinary people lost homes and jobs, while many of the institutions that built the leaky pipes were rescued. That tension still shapes how people feel about banks today. Here's the uncomfortable truth, and the reason this story isn't really about 2008. Every financial crisis in history rhymes with this one. Someone finds a pipe everyone agrees is unbreakable. The world piles its money onto it. Because it feels safe, people stop checking it. Then they build risky bets on top of it. Then they build bets on those bets. As long as the water keeps rising, everyone looks like a genius. The danger isn't the leaky pipe itself. The danger is the belief that the pipe can never leak. That belief is what makes people stop watching, stop reserving water, stop asking the boring questions. So whenever you hear that some new investment is totally safe, can't lose, backed by something rock solid, that's the exact moment to look closer. Not because it's definitely a scam, but because unbreakable is the most expensive word in finance. The system runs on water, sure, but it really runs on trust. And trust is the one thing no emergency tank can refill. Thanks so much for watching. If you got value from this, hit like, share it with someone who'd find it interesting, and subscribe for a new breakdown every week. And follow us on Instagram at zavrek.official for more. See you in the next one.